This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Scott Norris here with your FOREX report. Today is Friday, February 2nd, 2007. Traders saw yet another incredibly volatile week in the Forex as the dollar struggles to find direction in the broad market. This week was packed with top-tier U.S. releases, which continued to paint an unclear picture of the economy. One of the most important numbers was fourth quarter GDP, which came in at 3.5%, blowing away estimates. Although this was only the preliminary reading, it is a huge improvement from third quarter figures and certainly bodes well for the greenback. On the other hand, we saw both the Chicago PMI and ISM manufacturing indexes fall below 50 this week. Other numbers added to the mixed bag, including the jobs report today. While the January payrolls figure fell shy of estimates, December saw a big upward revision. Furthermore, the unemployment rate unexpectedly ticked higher to 4.6%. Another report this week indicated that the U.S. savings rate dropped to negative 1.2% in December, marking 21 consecutive months in the negative. This is the first time since the Great Depression that we have seen such a streak. While traders do not appear concerned with or focused on this problem at present, it is something for us to keep in mind, along with things such as the U.S. deficits, as these are bigger picture issues. In the meantime, we expect that disappointing news from other major economies could allow the U.S. dollar to continue its trek higher. Now to the big picture. In this week's big picture, we're going to step away from fundamentals and focus solely on the big picture technical outlook. We have seen now more than ever traders respond in very curious ways to economic releases. It has become commonplace to see currencies spike higher or lower on a piece of data and then reverse without warning just minutes later. At the same time, we have noticed how strong and reliable certain technical indications on daily and weekly charts remain during these volatile and uncertain times. Some of the most important factors right now are the major moving averages, which includes the 20, 50, 100, and 200 day. Most pairs are interacting with these averages at least once or twice a week. The majority of the tests at these levels have resulted in rejection, changing the pair's direction in an instant. We've also seen pivotal peaks on the weekly charts for pairs like dollar-yen and pound-dollar tested and hold. Long-term trend lines on weekly charts for dollar-Swiss and euro-dollar are also playing a big role in recent movement. Of course, with day-to-day volatility so great, playing these longer-term signals will require traders to use wider stops and remain patient. Traders that do not feel comfortable doing so will have to resort to very active trading or simply wait for these longer-term charts to offer us a little more clarity. Till next week, have a wonderful weekend. Take care.